AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today on February 4th.
February 4th, 2021.
A couple interesting things happened today in history.
Oh, yeah. Actually, believe it or not, Facebook.
Facebook
got launched today, February 4th.
2004,
2004.
Right? Yep.
Of course, February is Black History Month, the shortest month on the planet, as they say. They say on the calendar months, a lot of contributions that Black Americans have made, and it's a great time that they actually get celebrated in the month of February.
It's still interesting. I saw a report today about home ownership rates are up. You know, they aren't quite what they were back in 2005, 6, and 7. They've come down, they're creeping back up, but, you know, the home ownership for Black Americans is only 41% compared to the national average, about 63%, which, you know, it's some disparity there. We'd like to see that continue to grow, and Black History Month is a great time to talk about that.
Yeah, actually, one thing that I was listening on the television this morning about the COVID shots and how they're saying that even though COVID is widespread throughout the nation, it seems the affluent areas the shots are getting more effectively done, and some of the other communities are lacking and falling behind. Yeah, it's kind of interesting. Well. I think everything in life is economics, so I always tell people, so where the money is where people get better treatment. That's just the way things are sometimes.
Well, I mean, it's not, you know, the mortgage industry has made a lot of leaps and bounds when it comes to equality. You know, there's actually a new application coming out. They've added how many pages?
I think it's like 12 or 16 pages.
And then the last one they added was another addendum to the HMDA information,
the demographic
information.
They've got all kinds of categories now that we can actually fill out on these applications.
Well, the reason that they increased the addendum for the Home Mortgage Disclosure Act, and that's the personal demographic information of borrowers, they really want to nail down banks that are discriminating.
Yeah, absolutely.
And so that's just one of the moves that they've made. And you know, but there are, you know, the first-time home buyer programs are there, and which do help, you know, but in a place like the Bay Area, it's very difficult. You have to make the money, period. There's still no doubts about that. So there's more systemic issues that will eventually help minorities in the United States and African Americans in particular.
Yeah, one of the things that we always talk about, we preach as if it's part of the Bible, is we always talk about credit scoring. One of the reasons why the credit scoring model came about is to have kind of get rid of or defer discrimination. They found a lot of times people were discriminated against because there were rules that were applying, but people were applying the rules to different people, to people's benefit. So with the scoring model, either you qualify or you don't qualify, and that's where it's kind of made the playing field a lot more level, and that way people have a lot more equal access to different credits and costs than they would before, rather than somebody interpreting what your credit should be, rather than looking at one score and see you've got a 740 score or you don't.
Yeah, I still remember the day. It was one of the first months or two I was in the business, and there was one of these disclosures that says that, you know, Fair Lending Act or Fair Housing Act is saying that we don't discriminate. And the guy didn't want to sign it. He says, I want to be discriminated. I want to be treated differently than other people. And we didn't do his loan. He didn't sign it. We didn't really want to do a loan with the guy like that. But those things I believe are getting better, especially here in California. It was very progressive compared to some of the East Coast cities that I used to stomp around in when I was much younger.
Yeah, like Sarah was saying, I was just reading, there was a guy who got kicked off the airplane just the other day. He didn't want to wear a mask. He thought wearing a mask was a fallacy, and he refused to wear a mask, and they put him off the aircraft. Interesting how people have different thought processes, and a lot of times people think differently, and sometimes we object to it, but it's how you feel. That's how you feel. As long as you're willing to pay the consequence.
Well, we're here to help is what I believe. This is the Real Estate Report on AM 1220 KDOW. We've been doing this for many years. This is our 11th year. Gordon, you've been in the business for 29 years. You're a professional real estate owner, investor. You like to resell houses, which is flip. He doesn't like saying that word. He flips houses. He also builds houses and manages properties, as well as does real estate and mortgages. It's great to actually be a partner with you. I think you've given us really good perspectives. And you were the first person I worked with in California, 16, 17 years ago. And it's fantastic that we've kept this relationship. And that's really a big part of what it's like to work with somebody in the business. We had a call from somebody today, in fact, who was referred to someone, like the cousin Vinny kind of thing, to do a jumbo loan, and he was turned. They didn't want his business. Those are the kind of people, they just didn't understand a scenario. So they called us and we figured out how to make a scenario work. And that's what established people in the business and professionals in the business are doing right now. And I'm very happy to announce that, that's what happened out of the mortgage crisis, the Great Recession. A lot of bad people in the business just left the business, leaving all the good professionals most of the time.
Yeah, I think the mortgage crisis, like everything else, that's why they say behind every dark cloud is silver lining. I always say that because it is actually true. We weeded a lot of bad people out of business. We went to a national licensing. We made things more equal, more disclosure. Everything is very, very translucent now. You can look at things and transparent, I should say, because it wasn't that way before. And now that we've had all these new rules, the Dodd-Frank came in, there's a separation of space between mortgage people and appraisers. People were not going to give appraisal business because they weren't bringing properties into value. So a lot of things have changed, which actually has made our business better. Most loans right now in our marketplace are what we call qualified mortgages. That means you do not get to sign up dotted line unless you qualify. And these are all the things that sustained for long. That's why you see the market right now is running for so long. We don't see a lot of these foreclosures because majority of people that have a loan in the last 10 years qualified for that loan through some form of qualification. It wasn't just fill out a blank application and got a loan done. It's made our business better.
It certainly has, and that does also translate into lower rates. For if you have a higher quality borrower and a higher quality product, i.e. the mortgage-backed security, that is really what your loan is. They wrap these all together. And they can sell that at a premium, which they turn around and they give that back as lower rates. And that's really where Fannie Mae and Freddie Mac and all of the other qualified mortgage lenders and products offer to the people out there. Right now, Freddie Mac's weekly survey has the 30-year fixed pretty much unchanged from last week, 2.73%, 15-year at 2.21%. People are taking advantage of this. There's no doubt about it. Applications rose last week about 2 or 3%, still on a great pace compared to what it was the year before and the year before, outpacing purchase applications, which is natural because there's lower sales, even though we are seeing some pickup from last year. But it is good news. Rates really are driving the market, and the low inventory is driving home prices up. We've seen some reports from CoreLogic. They just came out. December home price gains shot up 9% annually, according to CoreLogic's home price index, 9.2 to be exact. That's year over year. CoreLogic says the December data means the housing market closed out the year with the highest annual price gain since 2014, far exceeding expectations. Frank Martell, the company's CEO, said, at the start of the pandemic, many braced for the Great Recession era collapse of housing market. However, market conditions leading into the crisis, namely low housing supply, desire for more space, and millennial demand, amplified the rapid acceleration of home prices. And that, I believe, will continue as people figure out, we had this discussion. There was a sports show that was on the other day. The guy said, there's going to be low Super Bowl
attendance,
viewership, right? They monitor that by watching. They go to the cable systems. They say,
I think the Nielsen ratings, I think, was what they actually use.
Right, but they're doing it off on TV, and this guy was saying that there's multiple people at a party watching this, and he thinks that less people watch. But wait, those people aren't going to go to the party; they're going to watch it from their own TV instead of that one TV. So that's going to spread out. That's kind of what's happening in real estate, where people are saying, you know what? Oh, and there's another article we're going to get to about how the rural America is outpacing the shortage of inventory, i.e. the demand around the United States, because people are saying, I can now work from home. There's more buyers, more demand in those areas across the United States, similar to what it's like to not be able to go to a party anymore. We're going to go somewhere else.
Well, when COVID struck, there were a lot of qualified buyers that were actually sitting on the fence, couldn't actually get into properties, couldn't qualify, the multiple offer situation. And I think COVID kind of slowed the market down. So it allowed a lot of those people that were actually on the sidelines to get into the real estate market. And that is the reason why I believe the real estate market continued to flourish, even though we had this great pandemic that was seen to be drowning out all industries. So people that had money, that were prepared to buy, were actually able to buy. And a lot of these jobs, their jobs weren't predicated on them qualifying or not. So I think that's why the market continued. We had a low inventory. We had qualified buyers sitting on the fence. It's like a perfect storm that actually worked very well for the real estate, the industry we're actually in.
And I'm not sure if you mentioned, but the technology too is there. Not just on the buyer side, meaning you can work from home now in many cases. A lot of businesses are accepting that, as well as the lenders are accepting that. But the technology to doing home loans a little bit quicker, and facilitating really the need, especially on the real estate side, the showing of the houses, the virtual tours. Yeah, you eventually, have to go and see the house and make sure that it fits your needs. But all of that technology, especially, the way that the realtors are embracing this and working with the clients, or the consumers, that is, it's working.
Well, this week alone, you were talking to an investor about a second home, and the guy was saying, well, it's not really a second home because it's not in a second home area. And now people have multiple homes because it doesn't have to be a second home, what they call vacation type, resort type area to actually qualify for a second home. And that's a change that we've actually to apply, which kind of market can actually benefit from this type of
Yeah, I wish I had that
news.
guideline in front of me. A lot of loan officers still think it's the old rule, and they just say, oh, no, that can't be a second home. That doesn't actually...
Yeah, it doesn't play.
That doesn't play.
The rule
anymore.
has actually
the rule has
changed.
changed where you can buy a property as long as you qualify for both mortgages,
And you can still rent that property and still qualify as a second home.
but you can actually record some income on it on that second home, as long as you qualify without the rents.
Yeah.
So I mean, there's some of these rules have changed. So I think the way that the industry has moved forward has really, I think it's been beneficial. It's been accelerated. That's what the pandemic did.
Well, I think we've made a lot of changes. I think a lot of adjustments have been made. I still think there are some things that I could see that could change that would benefit the marketplace. But of course, I'm not making the rules, so I'm just a standby, just like everybody else. But I've been doing it for such a long time. I do think some of these things, if implemented, could actually make the market go a lot better and more efficiently. So I hope as time go on, technology is more embraced. Fannie Mae and Freddie Mac kind of really get rid of some of the idiosyncrasies we had in actually lending. There are still some things out there. I still pull my hair out when I come across these situations. Not as much as I do as time go on. A lot of these things are actually going away.
And there are some leaders out there in the industry right now. I would like to say it's the banks, but it's not. There's some great wholesale lenders out there that we work with that are the number one wholesalers in the United States. Number one as far as technology, making it easy as possible. We'll come back after this break. You're always welcome to call the show 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. That's BayAreaLoanSource.com. We'll be right back after this break on AM 1220.
Questions about real estate? Call the program 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today, February 4th. Wow, it was about a year ago when all of this started really happening. It's been a wild last 12 months. Obviously, the interest rates have kind of been that silver lining. Home prices have gone up. A lot of people who have been in real estate and gotten real estate as well. We had somebody who bought last year, and they've been very happy with some of the returns. But it's not just that. And, if you would have bailed on your house or kept your house back in 2007 and then dipped and then you're at all-time highs. A lot of people realize that. That's one of the reasons, we have a really good ownership pool. We talk about that all the time, Gordon. You just mentioned how people since, in the last 10 years have refinanced under some of the toughest guidelines, which also means what they call qualified mortgage ability to repay rule. And that means that the people who own houses are not going to bail. We talked about last week how the ownership tenure in a house, people are holding on their houses a lot longer now. They're living in the house. It used to be like 8 years, then it went to 10 years, and now it's like 13 or 14. It's a long time. It's because people are now, they're settled in, they have a good rate. And you talked about where are they going to move? That's the big question. If they sell, I got all this equity, what am I going to do with it? I can sell and go buy something else, but wait a minute, there's not inventory where I want to go. Besides, it's also going up as well over there, wherever that is.
Well, over the last couple of years, actually, if you watch the trend, home ownership has become more popular. Home ownership, like in the 70s and early 80s, was like a bad word, because we had those double-digit inflation numbers, interest rates with 15, 16%. People didn't care about home ownership. Once rates came down in the early 90s, and then we had that whole, the no money down rules, I think home ownership became very, very popular. And of course, we had a dip in the mortgage meltdown back in 2007. Ever since 2007, we've been actually back on the rise. So people now everybody wants to own a home, not just for a place to domicile, but they're looking for appreciation. They see a home as an investment, as some type of something to work towards a future retirement benefit. A lot of people do those kind of things. So homeownership is no longer just something that, we just do because we need a place to domicile. It's our biggest investment. It's the biggest purchase most of us would ever make. And it's very, very popular. And I think the market has really, really benefited from it. And that's the reason why you see all the appreciation in the marketplace, because it's such a sought after investment.
Yeah. Here's somebody that sent us an email, I believe is taking advantage of the equity. He says, this is, I want to refinance my first loan and take some cash out to pay off a rental property, right? A lot of people are doing that because that turns into cash flow. Higher cash flow, they have the equity, they can get a decent rate on their primary residence. They might stretch it out. Maybe if he doesn't have a big balance, maybe his payment stays the same. He's able to pay it off and he gets some deductions and, this works. He pays a little bit more taxes, but he says but this question goes on a little bit more. He has an equity line that he wants to keep, but the lender says they do not let a cash out loan go in front of the equity line. It's called a subordination. So if you have a first and second loan and you pay off the first loan, the second loan automatically goes into first position. So, but you can't get a first loan if the HELOC goes into first position. So you have to ask that second lender to stay in second position. So, and a lot of those lenders won't let you do that. Some of the options that this person could do is you could do a cash out loan and then get another second with what they call a simultaneous second. And usually if you do it through the same lender, they'll let you do that, right? But if it's just an independent source like a credit union or a bank, in many cases when you do the first loan as a cash out loan, they don't let you do it. But we found out there's one that does.
Who might that be?
Am I allowed to say it?
Yeah.
Patelco.
Okay.
Believe it or not.
Credit union. Okay.
Yeah, it was a credit union.
Well, a lot of times credit unions have a little bit more flexible guidelines. They
Yeah.
don't have the same guidelines that the lenders have as far as the FDIC and those type of very stringent lending rules. I found out lately, I was talking to 2 clients last week that were looking for home equity lines of credit, and they went to the big box stores, and they said they have a COVID overlay, which means that they're temporarily suspended doing equity lines until the market kind of rebounds. And they said probably begin in the second quarter, which I think is beginning in April 1st. So a lot of things do change as economics change. A lot of temporary rules that actually come into play, and you also got to be very, very aware of these things. I'm an advocate of always understanding what's going on in the marketplace, understanding what's going on with your credit, understanding what's going on with your finances, understand how much money you have in the bank, understanding to open your mail. There's so many little things that I believe that I'm an advocate of. A lot of times people don't do, and I think that's where they really suffer when it comes to credit, when it comes to being taken advantage of. I was on a website today, and they were saying it was a property tax website, and I listened to the message. They say, we will never send a person to your house to collect property taxes. It's amazing how people still fall for some of these things, and they actually get taken
the tax
and
collector.
actually losing money because they don't pay attention.
And yeah, you certainly have to pay attention, especially with the amount of paperwork that does come to you, especially after the transaction. I get, I did a refinance, and, that's public record. And I started getting all of these, for $115, you can get a copy of your title report. Wait a minute.
You get that for free.
I
Yeah.
have one.
So, yeah.
Yeah. Be aware of those. Call your lender and ask them if that actually came from them. Especially the ones that are illegal, the ones that look like they have some sort of government association to it. Those are illegal, and you can report them.
Yeah, they have some of the envelopes. It looks like it comes from the county or the state. You got to be really careful. The letterhead is very what they term, the legal term is confusingly similar. A lot of times people fall for that because people a lot of times don't read. They take a glance, and when they take a glance, it looks just like the yellow pages that used to come out. They used to always send these things here to the office to us. They're not the yellow pages. You got to read. It looks like the 2 fingers walking, but the bottom it says this is not the yellow pages, and most people don't read that.
Similar.
They just see the 2 fingers walking, and that's what they go for. So a lot of times, especially in today's world, you got to really, really pay attention with this technology. Your money or things can be gone at the blink of an eye. Simply if you're online and you get distracted. So many things can happen. That's why it's very, very important to pay attention to what you're doing, especially when you're online, especially any website dealing with finances, personal information. Sometimes those websites can change so fast. You'd be in another site without even realizing, and there can be damage that you might not be able to recoup.
And you might even be aware for until the damage has been done.
Yeah.
We are all about security. So if you want to call the show, you can talk about anything. 800-516-1220, 800-516-1220. Mortgage rates continue to be the story. Under 3% according to Freddie Mac weekly survey, 2.73% on the 30-year, and the 15 years at 2.21%. Those are great refinance opportunities for a lot of people. Surprisingly, I wish I had the number, but it's a large percentage. I think it was like 30% of homeowners that still have an opportunity to lower their rate and take advantage of lower payments. There's still a large amount of people out there that have either done, maybe their credit scores improved, maybe they had an FHA loan with mortgage insurance or any loan with mortgage insurance, or they had a non-qualified mortgage loan with higher rate. They're looking for some sort of exit strategy that, to manage, decrease that payment on a monthly basis. That's what these rates offer, is opportunities for people to save money on a monthly basis. If I told you save $200 a month, that's $2,400 a year. That's $4,800. That's $9,600. It keeps adding up over a period of time. That's what's the power of these lower interest rates. We also continue to talk about the flex loan. That's where, I don't want to refinance. I don't want to go to 30-year fixed again.
I don't want to start over the cycle.
I don't want to start over. Well, get a 24-year loan. Get a 22-year loan. Get a 29. We just did a 29-year loan. Somebody refinanced last year and they just did it again, but they didn't want to go back a year. Those things are available, and that's the progression that I think that we've seen with these lenders and these products.
And that's actually good. That's one of the things we talk about. That's a good mortgage product that's actually enhanced the marketplace, made things better for the consumer. I think these are the things that I'm talking about, that I'm an advocate of for the marketplace and for us as consumers, because I'm also a consumer too, even though I'm in the mortgage business.
More tools. You're welcome to have us help you. You can always email us, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We can help see what tools work for you. We'll come back after this break. I'm Tony Mendes. It's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendes.
And I'm Gordon Hines.
You can always call the show, 800-516-1220, 800-516-1220. We are live, and you can get your questions on the air, or you can email them anonymously if you want. Tony or Gordon at BayAreaLoanSource.com or info at BayAreaLoanSource.com. We appreciate all the comments that we get and the questions. This question comes from Castro Valley, anonymous. My son wants to buy a house, but his down payment is too low. The down payment is, the payment is too high for him to qualify with, even though his down payment is sizable. So, and this is the father, he's saying, is it better to co-sign for my son or gift him additional money for down payment? We could get him another $200,000 to that loan limit that he qualifies for. It's money he would inherit anyway. I like the gift money scenario better, because if anything ever happens to the parent, right? If anything happens to the parent, the son at least knows that he qualified for the mortgage that he has, right? And his money he's going to inherit anyway. The father can get it out of his house, according to the email, and he can get owner-occupied rates with that, unless it's some sort of weird jumbo thing or something's wrong with his debt ratios. But, the co-signing thing, Gordon, we don't talk about this enough, and we run into this all the time, where when you co-sign, you're on that mortgage. You're also, if somebody, and let's say I co-sign for you, and I just go, I have do my own thing, right? And then you make a late payment, it shows up on my credit, even though it's after the 12-month period where I'm absolved from the debt because you're making all the payments, it still goes on my credit. The other thing too is if you're co-signing, you're also on the loan, you go on title. So then there's some title issues later. Maybe if he sells the house, and you have to worry about like transfer tax and step up basis on the property if you ever get removed from the property. So I like I like taking money out of your house and giving your son the money.
Yeah, I think that's a great position to be in, actually. I wish I was their son when I was looking to buy my first house and getting $200 cash from my parents. I mean, these are all the things that people benefit from when they work and then pass things down to the generations. I got a call today from Sandy. Sandy's living with her uncle. They live in a fourplex. This owner has agreed to sell the fourplex to the uncle because he's been taking care of it for the last 20 years. The problem is Sandy doesn't make enough money to qualify by herself. The uncle doesn't make enough money, but the uncle is a veteran. She wanted to know, can her and her uncle buy the house using the VA, since they don't have much money to put down? They were trying to take advantage of 100% finance, and I think VA on 4 units, I think, goes up to 1.4, 1.5 million.
It's unlimited.
But that's unlimited. That's correct. I stand corrected. I forgot they changed that rule. But unfortunately, the only person that can actually go on
or what they call qualified veterans or a spouse
is a spouse. And unfortunately, even though she's not the spouse, she couldn't do it. So we have to find another method to actually be able to help them to buy that property. I'm still working. I don't have a solution.
VA is a great loan, but they do focus heavily on veterans.
The veteran.
But we just did a great VA loan. And again, you can go 0% down. I think what's unlimited. You got to make sure you find the right lender. There were some lenders that say, no. We won't even go over $1 million. The other one, over $1.5 million. So, but you still have to qualify. That's the thing. That's no matter if you get low down payment assistance or down payment assistance, or you have, 1% down, 2%. You still have to qualify for the mortgage. So that's really important as well. We'll come back after this break. Thanks for the emails. You can end the call from Sandy. You call the show 800-516-1220 or email the show, Tony@BayAreaLoanSource.com. We'll be right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
I'm Gordon Hines.
According to Redfin, 2021 housing market is shaping up to be even hotter than 2020. Home buyer demand is up 60% and 13% fewer homes are being listed than this time last. How can it be a hot market when it's only hot for sellers, right?
They must have been talking to Nelly.
I've always wondered that when they go hot, because the realtors are the ones who are making the money, and you guys are spending the money, and the sellers are getting the money. But we talked last week about how sellers have the highest percentage of or average dollar amount rate of return on their investment, if you want to call it that, ever. And I think that will continue. This is from a Redfin agent in Seattle. The main thing that's going on is the scarcity of homes for sale. There's nothing out there, so people want it even more. Potential home buyers who don't have a good amount of savings are having a very hard time getting a right house now because the lack of supply is driving up prices while low mortgage rates are increasing demand. Days on the market are starting in 2021 at historic lows. A 4-week average on days on the market, that's pretty good. It's really good, in fact. And then the historic shortage of homes for sale starts off with 34% year over year, lower than it was going back to 2020. It was actually a little bit farther than that. It's about 36% low from its high, which was near the beginning of 2019. So there's not a lot of inventory out there, and that's driving up the demand and that motivating people to really put their best foot forward. And I'm not saying it's snowballing forward like it did back in 2005, 6, and then 7, where that was artificially done in the sense where you add appraisers. You would, as a loan agent, you'd say, well, I'm doing a refinance or I'm doing a purchase. Well, I really need this property, talking to an appraiser, I need this property to value at $700,000. And he goes, well, it's not really worth $650 maybe. So you say, okay, great, thanks. You call another appraiser and they go, okay, I need this property value to come in at, $700. They go, well, maybe $675. You call the next one, they go, oh yeah, I'll do $700. And that happened over and over and over. And that created an artificial higher value.
Well, that the Dodd-Frank took care of that. That's the reason why you can't do that.
HVCC
You can't be able to manipulate the appraisers and force appraisers into giving you values that aren't there as a trade-off for getting business. But one of the things you just mentioned earlier, one of the things that I always talk about in the show, one of the most qualifying indexes is DOMs, what they call days on the market. If you really want to get a genuine, consistent evaluation where the market's going, you look at days in the market. Most investors, or excuse me, let me rephrase that. Most consumers don't really pay attention to days on the market, but that tells you where the market's actually going. How long properties are able to stand on the marketplace before they actually go into contract, before they go pending for sale. So that's one of the key indicators that we kind of sugarcoat, but it's very, very important to the stability of a marketplace.
Chief economist at Redfin says that, that's Daryl Fairweather, says that there will be a continued lack of new listings in early 2021. And then you got the home builders as well. They're not building a lot. But one of the interesting things is that there's been a significant shift of interest towards newly built homes, according to the National Association of Home Builders. In the fourth quarter of 2020, 41% of buyers were looking for a newly built home. That's more than twice it was a year earlier. So you have more people looking at new homes, maybe because all those existing homes they're just not selling. No, they're not getting on the market. So these, hopefully the builders step up and really make and satisfy some of this new 41% of these buyers. 41% of buyers are looking for new homes.
Yeah, I was out with a tour with a client not too long ago. We were looking at a lot of new homes, and a lot of these new homes are actually one of the few things that I do notice. A lot of them have what they call a secondary entrance, and also like a second kitchen, even a small kitchenette, which is can actually be included as an ADU, an auxiliary dwelling unit, or a place for an older kid to live in and still have a separate space between the house. So it's interesting how builders are changing their philosophies. It's trying to amend their thought process and their builder design to what the marketplace is actually calling for. Because people, as they stay in homes, they want the kids to stay home. I think that separation of space is great when you have a big house where an adult child can stay there, have their own privacy, and be their own adult, and not have to go through the family business, which is actually a great thing.
I did see that. I don't know if everybody saw the article about how to save money for your down payment. One of the trends now are children or kids are moving back, working adults are moving back in with their family, and they're suggesting that. And they had this whole chart about how long you have to live with your parents in order to put down 20% on the median priced home in that city where your parents live. I thought it was a very interesting article. I didn't really thought it was newsworthy until about now, but that is one of the ways you can save money. You might have to make that sacrifice. When I bought my first house, I knew I had to work every day. I was commissioned. I had to work 2 years commissioned before I could even qualify for a house. That's kind of how it works. And we sacrificed. We both worked hard, and we bought the house.
When I bought my first house, I
saved money.
I took on a second job. I was working at my place is now gone defunct. I don't know if it was because of me. I took on a second job working at Circuit City. I was working 4 nights a week plus all day Saturday and all day Sunday. And that was part time. But I needed the extra money to save the extra money in order to come up with a down payment. And back then, first house was only $99,000. But that's where the market was back then. And as a young person trying to make it, trying to save money, that's what I had to do.
Well, if you look at the demographic score, and I'm not sure how often you look at these numbers, but 60% of millennials that are buying are getting help from other sources, not their down payment, but other sources, 60%. But once you get to the other older generations, that number starts decreasing more and more and more. And a lot of these, Generation X and baby boomers, they just that fell off the map, during the Great Recession, are trying to get back into the market, are struggling because they're not going to go out. You have kids, and you want to be with your kids, and you don't want to get a second job. You have to make other types of sacrifices to get in housing, like moving and going to an affordable area, because there is a significant change in affordability in large cities compared to rural and suburban areas.
And a lot of these big profitable companies are offering incentives to people that work there as far as down payment assistance programs. I did a loan for a company the other day. A lady worked for a big company in San Francisco, down payment assistance. It went on to the second. As long as she stayed there for X amount of years, that loan will be forgiven. It's kind of interesting thing how you help people stay in the area, you help maintain your business, help retain good employees, and it's a good concept. That's why sharing the wealth is so important, because the more we share in the wealth, I think we can have a lot more successful community, and of course a happier worker.
All of these things are really coming out of the pandemic, Gordon. I don't want to call them all silver linings, but they put these kind of issues in the forefront of how we are going to buy housing in the near future. Where are we going to move? Where are these jobs moving to? I mean, you saw Amazon, they're moving that huge headquarters to Washington, D.C. area. You have Tesla and other places moving to like Reno and then Texas, and Apple's moving stuff in Texas and so on. This, by the way, Austin is one of the most looked at areas from Californians looking to move out of the state is Austin. And we're seeing this migration. We're seeing all of these pieces work together. You called it the perfect storm. I don't think it's quite perfect yet. I think the other step is for companies to really start working towards that technology and allow people to work from almost anywhere. And that will help spread the wealth out a little bit more, and then build communities in other places around.
Yeah, well,
strengthen communities.
Yeah, flexibility is very, very important for any job. I think the more flexible a company can be with a worker, I think in most cases, the more successful that worker can actually be. Especially one of the biggest challenges for a worker, believe it or not, is childcare. Having somebody to take care of that child, dropping that child off early in the morning, picking that child up in the afternoon on the schedule is really tough. That's why a lot of places, some of the bigger companies have childcare on the ground. Some of these big companies that have like campuses of childcare, you can come there and spend lunch with your child. All these things make for more efficient, happier workers, and then we have better products in the marketplace, better ingenuity, and it leads to a better economy.
We're certainly going through some changes. If you have any questions about these changes, or any ways that you want to get your foot in the, what do you call it, game money?
Door. Skin in the game.
Skin in the game. We can help you out. Give us a call, 800-516-1220, or shoot us an email, Tony or Gordon at BayAreaLoanSource.com. Again, this is the Real Estate Report on AM 1220 KDOW. Be right back after this break.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Freddie Mac Weekly Survey has 30-year fixed 2.73%, and the 15-year 2.21. This is a gauge of what direction rates are going. It held steady from last week. There is a jobs report coming out tomorrow that could create a little bit of volatility that depending on what kind of numbers that we get. And that's kind of what we're going to be looking at this whole year is volatility in mortgage rates. So if you are thinking of taking advantage of these rates and you think they're a little higher than you want, they'll probably come back down and then go back up. Come back down, but you have to be ready. Don't just wait for them to come. And don't follow these reports. They come a week afterwards.
Right.
So,
we always tell people that those rates are benchmarked. We get a lot of calls. Well, you said last week Freddie Mac was at 2.2, and now today you're offering me 2.5. And we always say rates are always changing. It's a benchmark, of course, and we have what we call risk-based pricing. Your rate has to do with loan-to-value, credit score, all those kind of issues. So don't think it's deceiving. It's just the sign of the times as far as the market's concerned.
This is an email from Gary. He says he's doing a refinance with a local bank. They are offering me 2.999% for a refinance on a $200,000 loan. I enjoy the fact the APR is also 2.99%. That kind of gives you the APR is a representation of the cost. So if your rate's 2.999 and your APR is 2.999, that kind of indicates that it's a lower, almost low-cost loan, no-cost loan, but it's not. He's wondering how other people are getting lower rates than this. They are not offering me any rates lower than this 2.999%, and I really want the lowest payment as possible. Can I get below that rate? Well, we don't know your situation, but I'm assuming that 2.999% with an APR of 2.999% is a paper loan. Okay, $200,000 loan is what they call the conforming limit, under the conforming limit. So, and it sounds like you have a decent credit score. There are banks.
Well, he can always ask if he can buy his actual rate down if he wants the lowest possible rate.
But there are banks, and this happens to be one of them, that will only offer you one rate. They will not give you the options. So we were glad to send this person what we call a kind of a
grid
rate sheet, a grid that shows you what it would cost you to go down, what your APR would be if you went from let's call it 3%. So I have to say all those nines, 3% to 2.875 to 2.75, 2.625, and so on. And then the lower you go, you lower your payment goes, but your costs go up. We've always said that at some point it doesn't work, but 99% of the time when you lower your rate, even though your loan amount goes up, your payment will be lower. So in this situation, Gary, I would simply just go to, a lender or a broker like us that can offer you multiple options on what rate. And there unfortunately are still lenders and banks that only offer one particular rate. And they say, this is what you're going to get.
Gary, if you're listening, call us back. We'll help you out, get you a better rate than what they're actually offering you.
So, and that's the combination of, cost or the relationship between cost and rate and payment.
And tell them we just got some good news from the producer.
The show does repeat. If you missed the show tonight and you did not get enough chance to listen to us, you can always listen to us on Wednesdays. They will replay the show on Wednesday nights the following week.
Same time, 6 to 7 p.m.
6 to 7. You can also download our podcasts at our website, BayAreaLoanSource.com, or you can stream live at KDOW.biz, as well as plenty of other fantastic informational shows that are on KDOW.biz.
Yeah, it's great. I love the emails. It's always good. We get to talk about different scenarios, what different people are thinking. Sometimes people are a bit shy by calling. A lot of times people don't call because it's a drive time show. But the emails keep coming, and we don't get to all of them. We try to get to the ones that are pertinent. Some of them don't make any sense. Some want to stay anonymous, but for the most part, Gary, in his particular case, didn't want to stay anonymous. We will hopefully be able to help his situation. Hopefully, we'll call us back and we'll email him back, of course, tomorrow. Make sure we can get him in our repertoire.
There's one thing that did come out of the mortgage crisis, the Great Recession, and that was Dodd-Frank and the new what they call loan estimate. And it was supposed to make things a little bit easier for people to understand, and it kind of did, and it kind of didn't. It tells you a lot of information about the loan, and the important things like your you don't have a prepayment penalty, or your payment can never go up, your rate can never go up. What is your term? Are you impounded? Your taxes and insurance. But then the next page on that has a lot of weird fees. They don't talk about APR until the end, but they never really break down what are APR items, and so it's still a little bit confusing. If you are confused about something that's being quoted to you, and you do have something called a loan estimate in front of you, we'd be glad to look at it. Just send it to us, and we'll tell you if that's a good deal.
Yeah, one of the biggest questions that we always get with the loan estimate is what they call the anti-steering. The anti-steering is something that throws us off. Some of the lenders that we work with, we have to disclose rates that aren't available. Like, for example, sometimes I had to disclose a rate the other day at a $40,000 cost, and I'm saying this is ridiculous. It's not an option telling somebody to do a loan refinance this cost.
There's some flaws in
they need to fix it.
Yeah.
They need to fix it.
Anti-steering is one of them, and the reason that anti-steering basically is you're supposed to choose multiple rates and what the costs are, so that you can see the options of what you are, what's available to you. But the true intent of that is so that the lender or the loan originator is not steering you towards a product that makes them more money. So it doesn't really quite fit. It doesn't accomplish the intent of what that rule is. So
what it does, it confuses a lot of people, and that's what we're always
people.
explaining.
So why can't I get this rate?
Well,
the
costs.
We are up to any emails, Tony or Gordon at BayAreaLoanSource.com. That is, of course, our website. We have a newsletter that we do on occasion, and we can talk rate and scenarios, as well as any real estate questions that you have. You're always welcome to shoot us an email, Tony or Gordon at BayAreaLoanSource.com. It's been an interesting day again today.
Fastest hour of my life.
Yeah.
6 to 7 every Thursday.
It's our 11th year on the air, and we will eventually open a bottle of champagne when we quit the show, but we are here to last, and we are here to help you. Again, you can always email the show, Tony or Gordon at BayAreaLoanSource.com, or visit our website, BayAreaLoanSource.com. I'm Tony Mendes. That's Gordon Hines here on AM 1220 KDOW. This is the Real Estate Report. We'll see you next week.